Welcome to our training module, Currency Management for Growing Businesses, How to Manage Risks Without Breaking a Sweat. Why do businesses need to manage foreign currencies? Currencies don't need to be complicated for growing businesses, or for most businesses for that matter. Usually businesses first encounter FX when they start buying or selling goods or services internationally. When these transactions are paid, companies turn to their bank or another payment provider and simply convert from one currency to another at the prevailing exchange rate. Little attention is often paid to FX fees or how exchange rates evolved since the invoice or order was placed. However, cross-border trade often involves transactions with long delays between orders being placed and payments being made. These can translate into currency risks. The risk that changes in FX rates may destroy expected profit margins or add more to costs, for example. If a company buys and sells in foreign currencies, there are different ways to manage this process to save money. In this guide, we explain some of them in an easy-to-follow way. Other modules may also be relevant for those seeking more comprehensive guides to designing an FX hedging program, specific objectives such as balance sheet hedging or cash flow hedging, or an overview of the pros and cons of various financial instruments used for currency hedging. But why is risk management important for any business? Before diving into the practicalities of managing currency risks, it's worth asking why it is important to do so for growing businesses, particularly those already busy dealing with many other issues. Is this something that only large corporations have to care about because their financial results are observed by so many? Can a growing business wing it, just dealing with currency issues when they arise? As with many things, the answer to the above questions is it depends, and that luck favours the prepared. Anyone thinking that dealing with the complexities of foreign exchange for your business is hard now, be aware that it is most likely to be even harder when you find yourself in a stressful situation. And foreign currency surprises often come at times of economic stress. A good FX risk management process usually seeks to protect from big currency moves that are caused by other calamities affecting global trade that may also cause other problems in your industry. When this happens, the prepared can continue focusing on the areas where they have more expertise, the expertise that is essential to your business, be it logistics, negotiating new contracts, or even finding new suppliers or buyers. Secondly, growing companies are more exposed to economic risks than their larger peers due to weaker financial backing, less diversification, and a weaker negotiating stance, to name a few. Businesses can increase their chances of successful growth simply by addressing risks that may endanger them in case a bad scenario materializes. Unfortunately, so many entrepreneurs stumble into discovering their currency risks too late, as unwelcome events unfold, as UK importers did in 2022, for instance. As a result of the crisis in Liz Truss's government, the British pound sterling experienced a significant weakening, particularly following the announcement of the government's mini-budget on September 23, 2022. At its lowest point, the pound fell to a record low against the US dollar, reaching levels not seen since 1985. Only when such risks crystallize do businesses seek help and advice on how to deal with FX risks. But when forced by events to investigate available FX risk solutions, these companies are often surprised by how easy it is to put in place processes that can significantly reduce their risks. This is why we urge growing businesses to prepare for such eventualities in advance, and it starts with understanding what can be done. So how could one think about currency risks in a structured way? It all starts with foreign currency exposure. Currency exposure means that a business's financial results are sensitive to foreign currency swings. As currencies go up or down, the balance sheet, profit margins, or cash flows evolve differently than if trading in one currency. These exposures can have positive or negative outcomes. For instance, profit margins can become higher or lower, depending on how the exchange rates change and affect revenues or costs. But where do exposures come from? Currency exposures come from various sources. It depends on your industry and arrangement with your suppliers or buyers. Below is a list with some questions that can help identify them. Is there a currency mismatch between your revenues and costs? For example, do you source your products overseas and pay for them in foreign currency, but mainly sell them in the domestic market, or vice versa? Is there a time delay between order and payment on your cross-border orders, invoices, or contracts? If you sell goods or services to customers abroad, could you change prices in foreign currencies without significantly impacting consumer demand? What could you do if your international suppliers decide to change their own prices due to currency rates in the coming quarters? Do you ever have to commit to costs for goods or services in one currency even before finding buyers in another? Does your business own or owe anything longer term in a foreign currency, such as foreign currency loans or investments abroad? These and similar questions should, in turn, help reveal answers to 3 key areas. 1. Which currencies are your business sensitive to? 2. What is your level of exposure to these currencies per transaction or per period? 3. What is the duration of these exposures? However, not all exposures are risks. And once currency exposures are identified, it's important to understand how they translate into currency risks for your business. To do so, consider economic scenarios that can affect exchange rates in a negative direction for your business. FX risks are possible consequences of currency exposures, and they express how currency swings may risk the profitability or viability of your business. Assessing such risks gives you the answers in advance that you need to know in order to avoid such pitfalls. For instance, does the business go from making profits to incurring losses if a given currency exchange rate moves by 5, 10, or 20% in a certain direction in the next 3, 6, or 12 months? What realistic mitigating actions could be taken in such an eventuality? What would be the net result on your financials? It is useful to apply scenarios that are reasonable in terms of probability to make sure the risk is assessed correctly. Looking at how much exchange rates moved in historical worst-case scenarios is often a solid starting point for such analysis. A basic but tested approach is to choose a uniform, large but realistic move in FX rates across all currencies. Then rank currencies in terms of how likely you can see such a move happen. It is important to focus on the big exposures first, as these are more likely to lead to significant FX risks. If there is more than one foreign currency you are affected by, just listing them is not enough. They also need to be ranked in the magnitude of your exposures to enable focus on the most significant ones first. Before gasping at the amount of work required to do this, be aware that solutions such as hedge flows can make it easier to identify and quantify currency risks by simply connecting to your accounting or ERP system. Managing FX risks is finally becoming easier and more affordable for growing businesses. There will be more on this later in the guide. Currencies affect many businesses in the same industry similarly, but each business is somewhat unique in terms of its risk tolerance. So, while assessing risks gives a picture of where dangers may surface, a business must also understand the level of risk it can safely tolerate. Any for-profit enterprise is about taking risks to make profits. One of the keys to business success is understanding these risks. Nevertheless, not all risks are equal, and growing businesses more than their larger peers must strike a fine balance. As finance teams in growing businesses are often time-poor and resource-constrained, removing risks that don't pose a significant danger would drain precious resources away from more valuable tasks. However, as many less fortunate entrepreneurs have discovered, ignore larger risks, and you may endanger the business itself by risking its solvency and, thus, viability. A risk tolerance does not have to be specific to currency risks. It is something that, at its core, underlines an approach of a business towards all risk. Such an approach is affected by the realities of the industry the business operates in, cultural norms, and in some cases, even regulatory constraints imposed on such businesses. Larger organizations have executive boards deciding on risk policies and tolerances on behalf of shareholders. But in a smaller company, directors are usually the ones who make the decisions. This may come up in discussions with their accountant or bank relationship manager and boils down to a statement on how much risk the business venture can tolerate. A crypto startup founded by a group of young entrepreneurs may have a very different risk tolerance from a family-run business with a strong focus on social well-being, for instance. This table summarizes approaches towards risks, as they may relate to business tolerances. It should provide some clarity on which currency risks need to be dealt with. It can also inform a view on the quantum of risk tolerance for the business. how much it could lose in each period due to risks without being pushed into a crisis. Obviously, it is high-risk areas that demand the most attention, in particular if your business has a low-risk tolerance. What strategies should one consider for managing currency risks? It may sound counterintuitive, but financial instruments should not be the first solution for managing currency risks. Other currency risk management methods can be considered as they are sometimes more accessible and cheaper. A natural hedge, one of the most popular ways to remove foreign currency risks, is an avoidance approach where the business tries to match the currency in which it trades with its suppliers and buyers. In other words, it's about matching the currency of its revenues and expenses and the timing of its cash flows so it doesn't have to exchange currencies. Larger companies, for example, often move some of their manufacturing or other operations to the countries where their main markets are to achieve this. Obviously, it is not always a viable option for smaller businesses. A similar approach is to choose a currency, usually the home one, as the only currency in which clients are invoiced. However, only if the product or service is unique or sufficiently scarce may it be possible for a small business to dictate such terms to its clients. Another popular approach is the pass-through method, where a company adjusts its prices to cover currency effects. This can be a simple and robust method to remove FX risks if the demand for products or services is not sensitive to such price fluctuations. However, it is not without its own risks. It demands a very loyal customer base. Otherwise, you may lose demand if competitors are able to keep their prices stable during a large currency move. Furthermore, for some exposures, a business may not have the luxury of being able to change its prices. For instance, if its customers pay with a delay after the final price has been set, as happens between an accrued invoice and its payment. If you can't remove FX risks using other methods, it is time to consider financial instruments. Many currency specialist firms and fintechs offer FX conversions on the same or next day with transparent and consistent fees. However, it is also possible to buy or sell currencies at guaranteed rates on a future date, so-called FX forward contracts. FX forwards are similar to booking FX rates in advance. They enable a business to fix the guaranteed value of a foreign invoice or bill in its home currency whenever it wishes. This can be done days, weeks, or even months before payment is due. In most cases, transacting FX forward contracts has to be executed manually over the phone or on a clunky website, but new systems such as HedgeFlows enable growing businesses to access FX forwards markets with greater ease and transparency. Here is an example of how FX forward works. Imagine a company, Widgets Limited, that produces its goods in the UK and sells them to a French customer in euros. It offers credit terms to its buyer and is usually paid 60 days after invoicing. In this example, it invoices the customer for €100,000 on the 28th of February, when the exchange rate is 1.1020 euros for £1 sterling. So the company records an accounts receivable for £90,744 as it books the transaction on its balance sheet. 60 days later, the euro weakens against pound sterling. If the customer didn't fix the exchange rate in advance, it would convert at the exchange rate of 1.1310, fetching £88,417, and thus recording an FX loss for more than £2,000. If the company had pre-booked the exchange rate, however, it would have guaranteed a rate of 1.1050, for example, available for the exchange until 28th of April. The firm would sell euros at that rate, which is significantly more attractive than the prevailing market rate, and therefore avoiding the foreign currency loss mentioned above. With this contract, Widgets Limited would receive €100,000 from its customer and immediately be able to exchange it for £90,498, thanks to the guaranteed rate it fixed when the invoice was booked. Obviously, the earlier example highlights circumstances where managing currency costs is beneficial. Exchange rates can go up or down, and it may be better to wait for more favourable exchange rates, but this is not certain. This leads to a common misconception that booking exchange rates in advance, or buying currency forwards, is a type of currency speculation. This could not be more wrong when it is used for specific and real financial commitments, such as outstanding orders or invoices. Booking a guaranteed exchange rate for an invoice essentially removes the impact of future uncertainty of exchange rates on the financial outcome, no matter where rates are when currencies are converted to pay or collect invoices. Pre-booked rates simply guarantee a certain value of the invoice in a business's home currency. In fact, it is the failure to fix exchange rates for committed future cash flows that leads to a speculative outcome. The business essentially gambles on whether rates go up or down, driven by factors outside of anyone's control, and, consequently, let the value of foreign cash flows fluctuate with exchange rates. The important thing is to have a clear understanding of the underlying exposures that you buy or sell currencies for. Buying or selling a currency without future currency cash flows to justify such a transaction would indeed be an example of speculation. To recap, these are the steps for creating a robust process for managing currencies in a growing business. 1. Understand where exposures are coming from and what they are. 2. Learn how to translate exposures into risks and quantify their size. 3. Select an appropriate method of mitigating these risks and implement it. This module covered the basics of FX management for growing businesses. As any company grows, its needs become more complex. More people and teams may make independent commercial decisions and contribute to the foreign currency needs and costs of a business. Larger businesses are also more likely to buy and sell and process a significant quantity of orders and invoices in foreign currencies. Pre-booking each and every order and invoice may therefore become a less viable and affordable strategy. The next module covers steps that larger businesses can use to implement a robust hedging policy that can help them manage currency costs and risks in a planned and organized manner. Future modules will also cover more advanced techniques that businesses can use to manage their currency risks, from forecasted transactions and other sources of currency risk. We will also introduce some accounting principles for businesses managing foreign currencies.